And hello, everybody. Welcome to Tax Time on the MTV network. I found out that this is a very popular show as I'm getting feedback from around the world. And some of them are going, gosh, we on this great show called Tax Time. And so just let you know where that all is at. Of course, I'd like to introduce our panelists for today's meeting on Tax Time. Scott Estelle, former senior trial attorney at our friends at the Internal Revenue Service, is one of our guests today. For those people who are also visiting, we also have our ERISA specialist from Kennewick in the Tri-Cities of Washington. George Seacott is a guest today. Panelist. We also have a CPA. I don't know how he has any time right now, but he's also a certified tax coach. John Power, CPA from Bismarck, North Dakota, is here today.
Good afternoon.
Yeah, good afternoon. Oh, well, it's afternoon already in Bismarck. It's afternoon here on the East Coast. And then, of course, we have Professor Dan Worthington, the former Associate Dean of the University of South Dakota School of Law, who's with us today. And then the president and founder of the IBM TV network, Kim Calhoun, has also joined us today, who also sits as a vice chair of the North Carolina State Computer Science Department. I'm not sure what computers have to do with taxes, but I guess we will find out a little bit about that today. Well, what?
A lot. We use computers to do our taxes.
Oh, that's right. Yeah, computers do.
I'm just sitting in to learn and help out, but I'm going to beam out now. So.
Oh, you're going to beam out? Well, maybe you could help us out how these computers. Well, actually, she actually brought a good question up. Is computers doing taxes and computer audits? George, I don't know about you, but do you see a lot in your practice of these automatic letters generated by our friends at the Internal Revenue Service and computers auditing?
No, we definitely do. An area, in the benefits area where I've seen a lot of activity, even during the past 4 years, when some areas of enforcement that may have been higher priorities in the 8 years before that were changed. In other words, during the Trump administration, their administrative or enforcement priorities definitely changed. But one area that we saw that would happen regularly, ACA, Affordable Care Act tax penalties, the IRS's computer systems were literally just screwed up. I mean, we'd have people that would file properly, and then they'd get these non-compliance letters that were computer generated, and that the records that the IRS had in their system bore no rational relationship to the filings that we could prove that were made for our clients. And so, granted, that's and you would say the ACA penalty taxes are newer taxes in the big scheme of things. And so, I guess you would say it would take a bit for the IRS to get their systems working flawlessly. But we've seen a lot of that over the past several years. Just letters generated based on alleged filing facts that are inaccurate.
Mm-hmm. Yeah, and Scott, you used to work with the Internal Revenue Service when you were there as a senior trial attorney. Did you have a lot of bots that did audits? In other words, where all of a sudden you get computer-generated audits, basically, Scott?
Well, when I was at the IRS, we're talking about decades ago, centuries ago. I don't know, it was a while ago. So, but I think the problem though is that the IRS computer system is probably pretty similar. I mean, I left the IRS in '94, and my guess is that the computer system is still back in the '90s or whatever. And I don't know. John was on my show a couple weeks ago, and we talked about some of the IRS audits, and a lot of the IRS audits now are on computer matching, where you get a W-2 and you don't report it or whatever, and the IRS is calling that an audit. And so when you think about an IRS audit, you think about some revenue agent coming into your office and creating all kinds of trouble. That's really not the average audit today. And the other thing about the computer matching system the IRS has is IRS can't match K-1s. And if you think about all the investment income that comes off of 1065s, which is a partnership return or LLC return, 1120s, S for an S corp, all these different things, and they produce K1s that the numbers are coming from all these different sources, and they can go to different places on the personal tax return that the IRS computer system can't match it. And that's just one example of probably hundreds of different examples of how the IRS computer system is still back 20 years ago.
Yes. And Dan, since you work in the area of estate planning, do you see this also in estate tax returns? Do they have computerized audits? Dan?
Well, typically not as frequently. I mean, with the credits being so high, it's typically only going to be in larger cases where someone's taken up a tax position that's contrary to what the service wants them to take, a larger discount on a partnership or something that the IRS wants to challenge for some reason. So I think if you practice defensively, you can prevent many of those problems and challenges. But still, they do audit estate tax returns occasionally.
Mm-hmm. Yes, and the way I understand it, they actually make more per dollar auditing estate tax returns than any other return. In other words, it's a very high profit margin type of business. John, since you're on the front lines, do your clients get a lot of these automatic bot audits from our friends at the IRS?
Oh, tons. It's by far the vast majority of contact that a taxpayer will have with the IRS is going to be some sort of correspondence. As Scott and George mentioned, that's the matching is a big deal. Even if sometimes the information is on the return, but it's just not in a way that the IRS computers can recognize. And then the unfortunate part is what I've seen is probably, I don't know, maybe half of the notices are just incorrect, but they still require somebody to respond to because people are intimidated by it. The first thing that some clients say is, should I pay this? And I said no. First thing you do is send it to me, let me look at it, and then we'll respond because odds are it's wrong.
Oh, really? Wow. That's not good to hear. George, since you work primarily in employee benefits, and I've been out your way in Kennewick, Pasco, the Tri-Cities, how do you manage a employee benefits practice from what would be known as Eastern Washington?
Does anybody care where you are now?
Okay, so you work all over the Western United States. Tell us a little bit about your practice, what you do.
Traditionally, my long background is on the retirement plan side of things. When I came out of college in 1989, I began my career as a pension actuary with what was then called Hewitt Associates. And after a few years doing that, I realized the lawyers got all the interesting work and the actuaries got the dull work. So I went to law school. But coming out of law school in '95, having that employee benefits background was very attractive to firms, and so I got right back into it. And at that time, the majority of ERISA or employee benefit work was retirement plan based, and in some ways it still is. But over those 25 years since then, a lot of the complexities in the retirement plan system have been resolved. I mean, there are still plenty of technical areas that you need, but a lot of the areas that were unnecessarily complex have been resolved. There used to be different annual deferral limits for 401ks, 403bs, 457s. They've unified all those. That's just one really easy example. They've streamlined some of the protected benefit rules that make it easier to eliminate optional forms of benefit. things that kept lawyers busy. They've made them easier on the retirement plan side. There's still work there for lawyers, but it's a lot of clients go for that retirement plan work first with their TPAs, and so the lawyers have as clients a lot of times TPAs, because if there's clients that questions that stump the TPAs, they'll come to a lawyer. Okay, that was a long answer to your question, but because retirement plan has become a little more simplified, at the same time, the health plan side of the world has become more complex. And so over the past, I would say the past 18 to 20 years, my practice on the retirement plan side has grown significantly. And, I would say there was a lot going on before the ACA. The market was evolving in ways to get more health coverage to more people. And then the ACA came in and just basically applied a uniform solution to everybody across the board, and also worked very hard to kill a lot of the organic development and growth that was going on before the ACA. Ideas that they just didn't like because they didn't fit the ACA's worldview. So there's been a lot of work, ACA compliance. There's been a lot of work helping brokers and plan designers try to maintain some of their own creativity in the face of the ACA, which makes it difficult. So I do all areas of ERISA, retirement and health and welfare. And yeah, I do it from here, talk to people on the phone.
Right.
Pre-COVID, I would travel 4 or 5 times a year. Obviously, the past year, hardly anybody traveled anywhere.
Right.
But doesn't really matter.
Yeah, I know. I totally agree. And Scott, you actually did a survey about the Biden tax plan. Can you tell us a little bit about what Biden's tax plan is about and what is going to be the future of taxation here in the United States? Scott, you got to turn on your mic. The floor is yours. You got to turn on your mic. Very good.
Yeah, sorry about that. Little loaded question there, though, huh? As far as what the Biden tax plan is going to do. Well, the Biden tax plan is not going to reduce your taxes. Let's just start with that, right? I think you're going to see, not this year, but in 2022, you're going to see increases in taxes. The corporate rate, I think, will go up. I think it'll go up for small businesses. I think it'll go up for larger businesses. I think you're going to see, some sort of, always with taxes, it seems like it's an allocation issue. It's sort of a social engineering, who gets what out of the tax pot. I think you're going to see more of that going to the lower income people. And, it's kind of interesting to me. I think if you look at the parties, it seems like the Republican Party typically will give tax cuts to the wealthy at the exclusion of the poor, if you want to make generalizations. The Democrats seem to do the exact opposite, right? That any chance to tax the so-called rich, they'll do it. But notice, I think that both parties leave out the middle class, and so I'm hoping that Biden will recognize that raising taxes on the quote-unquote rich, whatever that may mean, may not bring in the revenue that he thinks it's going to bring in, and that looking for middle-class tax cuts, I think, would be the way that I'd like to see Biden go.
Hasn't he basically, at least during the campaign, I haven't read any proposal since then, but, the threshold I recall him talking about in the campaign was 400 grand. If you earn 400 grand and above, you're somebody who he wants to raise taxes on. If you're below that, he doesn't want to mess with you. But some of the things that have been proposed since then have already gone against that, but that was at least the purported threshold.
Yeah, I think that's a fair statement. The 400 grand went on the flow through businesses, so our S corps, LLCs, or whatever, that you're going to lose the 20% maximum deduction that you can take off of that income once your income hits 400,000. And there was also going to be a donut hole on the Social Security taxes as well, where if your wages are between whatever the cutoff is today, 130, 140, whatever it is, and 400, you won't pay anything. But once it hits 400, you'll start paying again. So for whatever reason, this 400,000 is a magic number. But, for a lot of people that I've seen on tax planning, I know $400,000 is quite a bit above the national average, and it's a lot of money, but there's a lot of taxpayers can hit that, if they maybe sell a rental property or a big capital gain or something, can push them into a higher income bracket than they were accustomed to being in. So the tax planning, I think, gets tough. And, until we know what that $400,000 number is, I guess we'll just have to sort of sit back and probably plan to take a little more income in 21 than 22 to anticipate higher rates.
Do you think people will actually do that, though, Scott? Actually try to bring the income forward in 2000? John, you're saying yes, people are going to bring more income in 2020?
Oh, definitely. It's always a discussion when you're looking at rates. Do we take more income anticipating rates are going to be higher in the future? It's always a bit of a crapshoot, because unless something has actually been passed, we don't know. And the devil's always in the details. But certainly people who have that flexibility or have an event like Scott was mentioning, selling some sort of asset, deciding when to take that income is a big part of tax planning.
Mm-hmm.
Wow.
What about tax deferral through retirement plans? George, don't you think that there's going to be an increase of people using retirement plans when there's a higher tax bracket?
No doubt. When we on this show, I don't know, it was 2 weeks or 3 weeks ago, but I do think it was the first time that I was on here, maybe the second, is when it hit me as we were talking about these new higher rates. So there's no doubt that suddenly, retirement plans are getting more attractive to more people.
Yeah, and when I looked at the Senate when they passed the Secure Act last year, that was supposed to enhance retirement plans, and they put in all these benefits, including our credit right now is $5,000 for a startup plan. The IRS will give you a tax credit because they really want people to do these retirement plans. And it was passed very favorable. I think it was 73 to 21 in favor of the Senate. And the reason that's so important is that, as we saw what happened in Washington, D.C., you can unbind through executive orders all these changes, and you could unbind the retirement plans by passing a new law saying, hey, they're no longer tax deductible, and they're no longer you can have the tax deferral. But they didn't do that. They're actually encouraging people to set up retirement plans. So, George, don't you think that cash balance plans are going to increase more in popularity in 2021?
No.
And he froze up. So, at least temporarily, on that. John,
I think that's already started a little bit, Nick, because when you factor in things like the QBI deduction, the qualified business deduction, getting income below threshold levels for somebody who's a specified service trader business, retirement plans, large retirement plan contributions like cash balance plans, fully insured plans, whatever, can be a real important tool in helping accomplish that. So I think it's going to accelerate that trend.
Yes.
Agree, John. And sorry, I'm back, Nick. Sorry, I froze up for a second. Already the people who are earning above 400, I would already call that kind of the sweet spot target market for cash balance plans. These are people who make enough that the defined contribution plan limits don't provide enough savings opportunity for them, so they want to look at the DB limits, which can allow them to save significantly more money. And so if that's your target market already for cash balance, and we're going to take that target market and we're going to jack their rates, which is what the president said he wants to do, well, then you've just made your target market is now even more of your target market.
Mm-hmm. Yeah, and wouldn't you even have to push more of your accounts into IRAs, profit sharings, and 401ks? Because I believe, Scott, correct me if I'm wrong, that his plan is to actually make the capital gains tax equal to the current income tax. Would that be correct?
Well, yeah, he was talking about doing that for taxpayers, I believe, that make over $1 million. So they would take long-term capital gains, which are very, very tax favored, and make them very untax favored, if that's even a word. But I think the hard part here is like John was saying, if we find out let's say in July or August or something, that this is what the tax laws are going to be in 22, or what it looks like it's going to be, I would absolutely be advising clients to accelerate income into 21. I mean, maybe, sell some stocks that you have long term, book the capital gain, and then reset your basis on whatever you bought it with. Same thing, as far as like what George was saying. The higher the income tax rates go on ordinary income or capital gains, the more attractive a retirement plan becomes. I mean, whether it's just an IRA or whether it's, a defined contribution plan, a 401k, something like that, or defined benefit plans, people are going to be looking for ways to get either tax deferral at a minimum or some sort of tax-free earnings, similar to a Roth. And again, the higher the rates go, the more attractive those vehicles become.
Mm-hmm. Yes. Besides Dan, besides opportunity zones and retirement plans, Dan, have you seen anything out there that would be advantageous to high-income taxpayers in your pike?
Oh, some of the more sophisticated charitable planning tools are certainly useful, especially in combination with some of the estate planning strategies. I do some of that. There's the typical programs, to the extent they will still exist, which I kind of doubt, because like oil and gas intangible drilling costs is likely to go away. The deduction for that, a bunch of other things that did exist to help encourage exploration may go away. But, here's the thing we have to remember. Any tax proposal that they finally put together will likely be into next year, and then you're going to have people in the House running for re-election, and they're going to be running for their lives because people are kind of ticked off at this whole thing, and so it's not going to be a popular thing to vote in a tax bill next year. So you'd think that maybe that might not be the smartest thing for them to do, but we'll see. I mean, whatever. Biden could get it done with executive fiat, he will. We've seen that. How many executive orders are there now? So the emperor is beginning to have no clothes. During the campaign, he called that dictatorship, didn't he? Is that his words? I can't do some of this because it would be a dictatorship. It hasn't stopped him, and I don't think he knows half the stuff he's signing, frankly. I think it's just shoved in front of him by his managers, and he just does it because that's what they want him to do. So, but where you have to actually have democratic processes at work, and to some measure compromise where you've got a couple of more conservative Democrats in the Senate, and it may not help to have, Vice President, whatever name they have. I don't want to get it wrong. Kamala. Did I say that right?
Kamala. Like a
Hey, Dan, as they used to say in Washington, D.C., good enough for government work.
Well, anyway, my point is, she only gets a chance to vote if it's a 50-50, right? There's going to be probably a backlash on a lot of this stuff because people only be pushed so far before they start saying enough's enough, and politicians have this bad habit. They like to get reelected. And so to the extent there's enough political dissatisfaction with what the Democrats are trying to do to take money from everyone and redistribute it to people that don't have it, it may be a bad strategy by, we're running up to the primaries for next time around.
Mm-hmm. Yeah,
I want to just interject just for a second because I've read some policies and bills in my lifetime, and honestly, I don't know who could read all of the ones that are there and some of the capacity that they're in, and honestly say that they read them, understood them, and signed off on them. I don't think President Trump did. I don't think Obama did. I read Obama's bill from cover to cover. I'm just curious who actually did that and voted on it.
No.
I just don't think anyone can read. I'm not defending Biden or anybody. I don't think anyone can read all of the bills and policies that are there and honestly say that they did before they voted on them. And there's so much in them. There's just, I've read a few. I've not read probably as much as crossed their desk, but a few that I was interested in, and it was just shocking to me that what goes into them. But I agree. I think that there's a lot of things that's being pushed or knee jerk that really need to be evaluated before we sign off on them. We need to do a little bit more risk management and some planning. But I don't know what goes on there, because I don't think anyone's really interested in that. I think they're more interested in their votes. But,
Well, no, you're right. Like tax policy, a lot of tax policies made by the tax wonks in the policy committee who aren't even in legislature, right? There are these. I mean, this is how we got the new rules on shorter remainder trusts dozens of years ago, right? It was from guys who were in the policy committee who decided, well, this would be a good idea to change the law in this way. So we need to get a 10% minimum distribution requirement. All this other crap that wasn't in the law before, that was set by Congress. It wasn't put in there by anybody that was elected. It was put in by the policy wonks. And so the thing that's been in existence in Washington for decades is they used to call it the Bronze Triangle. Now Trump called it the deep state. I don't care what you call it, but it's the people who are unelected who really are behind making the laws and pushing the agenda. And the elected officials just kind of smile pretty for the cameras for the most part. And their staffs, they go like this and feel the temperature in the air and decide which way to vote, and see how it's going to play in Des Moines.
that's how I do it.
Yes, well, I don't know how it's going to play in Des Moines, but we would like to bring our guest in, who's a financial advisor, Mark Katona, who also runs Financial Fitness on the Financial Friday on the IBM TV network. Mark, what are you doing talking to your clients about the new Biden potential plan? And I know he has one bill that's 5,000 pages, which we're going to spend $2 trillion that we don't have. And then there's another one that Scott went over, the new tax plan, which is to tax everybody more from the 2 trillion that we spent that we don't have. So what do you tell your clients what they should be looking for in 2021? Mr. Mark, I'm going to put you on the spot.
Uh-oh, here we go. I like being on the spot. Welcome, everybody. So you know what? It's very, very difficult, to talk about things today, especially taxes, okay? Because we really don't know where taxes are going to be going, okay? We do know that the sunset provision is supposed to be going away in 2026. But, and I say but, you have all of these hidden agendas that we really don't know. And so it's really hard to coach people. If you don't mind me, I'm just going to just throw this back and, somebody like Scott, you're on the call today. You being a tax attorney, okay, and I don't know, Mr. Power, are you an attorney as well?
CPA.
So I mean, right there, you so you have a CPA, you have a tax attorney, and you have myself. So my job is to try to be like the soundboard out there and give people choices versus, it's hard to tell somebody that their baby's ugly. So you have to do things in a very, very subtle way. Okay. Educate, number one. Okay. And when I say educate, I mean, these are the rules now. Okay. This is not saying this is what the rules are going to be in 2022. Rules have changed last year dramatically, with the Secure Act and the CARE Act. And Nick, you're aware of that. I know that, but I mean, someone having a Roth IRA today, and a non-spousal beneficiary, okay, or having a traditional IRA with a non-spousal beneficiary. Well, the rules of 2 years ago changed with those types of beneficiaries. So they got 10 years to get their money out, and at that point, it has to be out. So, I mean, talking to people, it's about looking at the entire picture, finding out exactly what they want, okay, and find out exactly what they have, and then breaking each component down, because what people have and what people want are not always the same. I mean, I had someone in my office just a little bit earlier today that, what she thought she had was definitely not what she had. And it's amazing if you do not show people they live in this fantasy world, and then when it comes time to go and act, it's like, oh my God, I made a big mistake, or this is what my belief systems were. So I'm dancing around it, Nick, because you have to. You really can't laser in until you find out all the facts of the individual. But getting people like CPAs, like John, John, are you a one-man show, or are you one with you have partners?
I'm a one man.
Yeah. So, I mean, my goal today is try to find CPAs to partner with. I just have found that a lot of CPAs, they come out of college, they're a junior CPA, they work with a senior CPA who work like dogs. They don't have no life. And I go to try to sit beside them. And Nick, I know you know what I'm talking about, because I found you working with the elite resource team. Okay.
That's right. That's right.
So my goal is to work with those CPAs and give them a life. Show them that we have a team of specialists that can perform every kind of strategy out there that the John Powers doesn't have to even think of even dealing with. He just focuses in on his relationships with his clients, and we just come beside them and work as a team, collaborating, so we're a better running engine.
Yes.
All
John.
on computers. All on computers. You put all this information and data on computers. That's why computers are important, Nick.
Yes, I do know they're important, and John can respond later about working like dogs, because I certainly kind of understand that. But George, one thing that Mark brought out, which at least we've seen in the retirement planning area this year, they're going to require the 401k and profit sharing plans to express the lump sum as a lifetime income, which George, is actuarial equivalent. But this is the first time. However, they're going to require us to do that. So we have to, us and anyone who administers 401k plans, to express these lump sums as lifetime income using all these formulas that the IRS. But will that have any meaning to a person who receives a statement like that, George? I know it's more work for us, but is it meaningful for the plan participants?
I suppose it is meaningful in some regard to help them from a planning perspective. I just hope, and you're going to get my outlook on things here. I hope that folks who receive this information talk to independent financial advisors, not financial advisors who are also insurance salesmen. Forgive me for saying that, but I think that this was the result of effective lobbying by the insurance industry, who wants to sell more annuities. And for some people, annuities are right, but for some people who have a little bit of appetite for risk, annuities are a very expensive way to spend your retirement balance. And I just want to make sure that people are well informed on the risks and the cost of risk aversion, and be able to make their decisions there.
Yes.
Go ahead.
Well, what you brought up is something that is kind of interesting from our standpoint, because earlier this morning I was on the board of our POA, and we're required to, we have $645,000 in cash. We're required to put it in CDs. Okay. In other words, we can't invest in anything except CDs. As you know, in the pension area I work with in fully insured plans, we're required to put it into annuities. And the real problem, as you know, there may be better investments in the annuity market. I'm telling you, it's suffering right now, George, because of the downward pressure on interest rates around the market. It is hard to get a decent fixed equity index annuity that pays anything. And the clients may be better off for the first time, I would say, in a cash balance plan or another type of plan. So what are your thoughts on that? And do you ever look at the difference between a fully insured and a cash balance plan?
Yeah, I mean, a fully insured DB plan versus cash balance. That's something that, somebody who's going to be looking at putting one of those plans in place ought to be aware of what both of the plans are, so they can make an informed decision of what is best for them. But that's a pretty different question, or a different, really substantive issue than this idea that everybody with an account balance based plan is going to need to know the annuity value of their balance. And
That's true.
Because just a real simple rule of thumb. Look at 5% of your balance every year and say, okay, you can comfortably take, whatever your balance is, you can take 5% a year, and and maybe even a little more than that. But that 5% is a pretty conservative approach, and I'd be curious to see what that 5%. That's the George rule of thumb. What's that how does that 5% rule of thumb compare to what the annuity value actually is if you purchase an annuity? I'm curious to that. But, people need to understand, the time value of money. That's an area where a lot of people don't understand. I would make a general. Somebody's got a lot of background noise and should mute.
Yeah, I don't know where the background is.
I would make a real general statement that most of your people who have significant balances probably have a bit of an understanding of but there's a lot of active participants, who've never worked in the financial area at all, who are building up significant balances from such as this.
Right. Yes, and somebody who's probably has significant balances. Let's bring in one of my favorite tax attorneys and also a professor at Northeastern University, Beckett Cantley. Beckett, welcome to the show.
Thank you.
I'm wondering what you're doing in this world of tax time, because you deal with international transactions as well as domestic transactions. Tell us, are your clients today, are they looking to do things more internationally or looking more domestically, especially with the Biden tax proposal, which looks to be pretty bad toward high net worth people?
Yeah, no, I mean, I don't have, there's not a lot of clients I have that are like gearing towards going offshore. I mean, it's they make offshore investments, sure, but they're more concerned with domestic taxes right now. I mean, because of what you're describing, the Biden proposals are really scary, and it's not just that; it's the rulings. Where the IRS is going to start issuing, Biden-appointed personnel rulings on interpreting code sections and transactions and whatnot, and it's going to get a lot. There's also an enforcement group that's just been created for high net worth individuals. So I mean, they're coming.
Mm-hmm. Yeah, and when you say enforcement group, what are you talking about?
There's I can't remember the name of it because it's brand new, but they formed it to literally just focus on high net worth individuals and do a global tax audit program. So it's not, I wouldn't call it a lifestyle audit, but it's in the same vein where you look at holistically at their entire return and not they don't get there by virtue of a transaction or one thing standing out. It's so new that no one knows exactly what the parameters are going to be, but the idea is go get money from rich people now.
Right. Okay. So the thing is, rich people basically have a target on their back. Would you say that would be correct?
Yep.
And what did they do wrong to deserve this target, Mr. Cantley?
Hey, why do you rob banks? Because that's what money is. I mean,
Well, I've had some wealthy people explain to me they have some problems with the American system because of this, and at least my experience may not be yours, that the wealthier clients that I run into tend to be more sophisticated, tax and financial wise. Would you say that would be correct in your practice also?
Yeah, of course, because they have a reason to learn it. Yeah.
Right. Yeah.
So but typically over recent years they've gone after folks because they have a specific transaction or a, you know, some real big event, you know, hits the Richter scale, but that's not what we're talking about here. This is just you make money.
Right. You make money, now you're subject to taxes, you know, and of course we do enjoy the Northeastern Graduate Tax Program. I got my Northeastern mug. Had to have that here for today.
I got my IBM TV mug, and I'm getting my classes right here. So.
And I also have my IBM TV mug, so I can get the classes. But Dan, you're talking about charitable strategies, which I think are important for people to understand. Can you give us an idea what charitable strategies exist today for high net worth and high income tax individuals?
Oh, sure. There's our old favorites. They're called the charitable lead trust, and there's both a grantor and non-grantor type. Can be employed in different ways. It's basically a time value of money play. It depends if you want the current income tax deduction or an effective have it completely written off, depending on how you structure it. And so you're able to get future dollars to your family under the credit. And, you know, I mean, you know, right now it's what, 20 some odd million, 3 million, something like that. So you could drive a bus through it, right? And get it out of the estate and that kind of thing. The opposite of that is a triple remainder trust, either an annuity trust or a unitrust, where you retain a unitrust or an annuity trust income for your lives. Typically, you replace the value of that asset with insurance that can be passed estate tax free in some sort of trust. Then there are all kinds of variations on the theme: pool income funds, charitable gift annuities, other things that can be part of an overall strategy from a charitable standpoint. But to go back to some of the things that you can do today for high-end net worth folks in the United States and offshore, some of the estate tax freeze approaches are very, very effective. You can do it in domestic asset protection trust structures, in qualified jurisdictions where you also get some estate planning and perpetuities play. PPLI wrappers where you can basically grow assets without, you know, recognizing income long term because of the rules around life insurance are always great, especially in their multi-generational trusts. You're basically shifting the tax liability either to a completed trust or the complex trust rules, or making it defective for income tax purposes. So either the trust can pay it or the grantor can pay it, and it doesn't carry out DNI to distribute net income tax to the beneficiary. So there's all kinds of games that you can play with more complex trust planning for the more affluent people to avoid the estate tax and freeze in your benefits now while they exist. And like I said, with the existing credits, you can drive a bus through that. That 23 million, 230 million is easy to do, and multiples of that depending what kinds of transactions. Self-canceling installment notes are another thing with interest rates as low as they are right now, can be very effective and can be structured. Private annuities, if you really want to go there, they follow a different set of regulations and evaluations and that kind of thing. So what you end up doing is playing with the actuarial tables and the calculators to see what strategies work best and with what assets. And so it really is like a game of playing Monopoly and creating structures and transactions based on the real needs of the family, what they're planning to do. Is the family planning to be involved in long-term management and governance of or are you going to be splitting it off and selling it, preparing to sell an asset, combination of the same? Is it real estate-based assets? Are you planning long-term deferral strategies to kick the can down the road on the appreciation, tax on the appreciation? The step-up basis may be going away. So still, deferral can happen if you're using exchanges, that kind of thing. So there's all kinds of things that can be done now that are under existing law to help people who are affluent to kind of prepare in advance for the Biden onslaught. The Biden onslaught will only be around for a few more years, and then the bums are likely to get voted out because nobody's going to be happy, and you'll have new bums in. So, hey.
Is that what's going to happen? The bums go out and then the bums go in. But
Well,
see, all the tools that you described are really for the 1%, Dan. In other words, the thing is, we're doing self-canceling installment notes, private annuities, charitable remainder trust, charitable lead trust. This is for the 1%.
Oh yeah.
Okay, the 99% of the population, do they really even care about a self-canceling installment note, a private annuity, or an estate planning freeze? Because
How many people are in the United States, buddy? 250 million now, or is it what? 300 million?
Around 330 million.
Okay, so what's 1% of that?
It's about 3,300,000.
Well, right, and so that's a lot of people, and that's a lot of
people, right?
So, yeah, those were clients.
Right.
On the lower range, though, many of the strategies for smaller businesses, like the charitable strategies, can work very, very well, and straight up life insurance policies to replace and that kind of thing. But we don't know what the estate tax problem will be. But those folks can still freeze their estate tax liability, essentially keep it and give it away at the same time by using structures and strategies like this. Say you got $10 million estate, same rules apply for the $10 million estate as it does 20. Just not going to have state tax liability. But the idea of planning this way is you create a pocket that's asset protected and will never be subject to estate tax again, no matter what it grows to. So yeah, it depends on what you want to do and what you want to see. Do you want it? Who you want as your partner, your senior partner, the government, or your family, or maybe you don't like either one of them, so you give it all to charity.
Mm-hmm. Yeah, well, the thing is, even Bill Gates, who decided to give it to charity, I believe he gave everything to the private foundation, which he controls, which is a charitable organization. Do you see, at least of course, I'm going back at least 20 years ago, one of my favorite strategies, the charitable remainder trust, with the remainder interest being a private foundation. And it kind of like does a number on the income and the estate tax. The real problem is it only applies to a very small percentage of the population today. Don't you see that?
Well, there's screwdrivers and hammers and fingernail clippers and other things. They're all different tools. You apply them to different sets of problems, and so you take the client where their problems are and what they're trying to accomplish. And you don't have to hit a fly with a sledgehammer, right? Fly swatter will work just fine. So you use the appropriate tool and the specific planning strategy. I've worked with people on all those levels, and some people are happy with simple solutions, and to the extent they are, that's their plan. It's okay. Keep it simple, stupid, right? Mm-hmm. But the extent that you have to make it more complex to help them accomplish their goals, then they have more of a tolerance to try to do that.
Mm-hmm. Right. Yeah, no, that's what I see also. George, when you work in the employee benefit area, do you ever work with the high net worth people, or are most of your people employees as part of these employee benefit plans? You have to turn your mic on.
Yeah, I'm on.
Okay,
there are high net worth folks who have all of their net worth wrapped up in benefit plans. I think I might have shared an example on this program a few weeks ago about an ESOP participant with, just a very $60,000 a year job who joined the company at the right time, and 25 years later has a $7 million ESOP balance. That's a high net worth person from my estimation, who's just a regular person, so not really used to dealing with wealth. A lot of times, also the high wealth folks we're dealing with are the people who own the business that sponsors the plan. So that those are generally my perspectives.
Mm-hmm.
Nick, there's an issue. There's something that Biden has proposed that I don't know if we got enough time to talk about it today, but the idea, he's all about equity versus equality, and he's put out there this idea that the wealthy benefit more from retirement savings than the lower earners, particularly based on our tiered tax rate system. The more you make, if you make a dollar contribution to a retirement plan, you save more in taxes if you're a higher earner. And so he's made this proposal for 401ks that you won't get a deduction for your 401k contributions, but rather everybody would get an an equal amount of tax credit. So, and the tax credit, I think, would be, done at a 20 or a 22% rate, whatever it is. So if you're somebody at the very low end who's only paying tax, if at all, at the 10% rate, now you're gonna get a 22% tax credit for your retirement plan contribution. And if you're somebody at the upper end who's maybe paying 39.6, 40, whatever it is, instead of getting your 40% tax deduction for your retirement plan contribution, you're only going to get a 22%. And be that what it may, argue that from a policy perspective, I don't really care. I mean, I can see where he's coming from. It is what it is. But what really bothers me about that is, what then is the basis in your retirement plan account? Are you still going to have no basis? Assuming you have all pre-tax. Is that still going to be considered pre-tax money? Or for somebody who's a higher earner, are they going to have some basis? Are they going to be denied that basis? It's interesting, and it opens up the terrible potential Pandora's box that we're always worried about, which is there's so much money in retirement plans. Congress wants that. They want to stick their claws into that money. And I see this as a backdoor way to start going there, and it's very concerning to me. And I don't know, has anybody else heard about that proposal?
I have, and the problem I have with it, George, and this is the problem I have with the current administration, especially Tom Perez, who was formerly involved heavily with the, I think it was one of our departments, and the problem is that they are very unrealistic as working with the people, the actual clients and the consumers of these retirement plans. In other words, in some states, most states, except I don't know if your state, California, recently passed a law mandating retirement plans in their state. Same with Oregon. So that if you're a business owner, you must set up a retirement plan. If you're in almost any other state, you don't have to set it up. It's voluntary. At least a lot of the clients I see who are,
they exist, Nick.
Pardon?
That's a whole other issue. But to the extent those laws exist, they're completely preempted. They're useless. Having value. States have no jurisdiction to force an employer to put a retirement plan in place.
Okay, I wasn't sure if that was litigated, because it does exist in Oregon and California. They passed laws mandating people that if you're an employer, you have to set up retirement plans for your employees. So I'll have to go check to see if those were overturned or not.
They may not have yet, but I promise you there is zero.
Yeah, there is an issue there. But here's the issue I have from a practical standpoint. As I meet people that are business owners and doctors and lawyers who set up these retirement plans, there's no real big benefit for them after they have to, quote, give their employees those safe harbor amounts. And so they're very reluctant to set them up to begin with. And when Biden's plan, assume it got passed, that would be just the nail on the coffin. They'd say, well, forget it altogether. I'm just saying.
We'll see.
Yeah.
So
better ways to do it. Why would you do that if you're going to be doing it in a punitive way?
Yeah, it's because the thing is, what I saw when we explained this when they were passing this fiduciary rule, we're explaining that this is going to be counterintuitive, that'll happen is people just aren't going to do this if we're going to have this big fiduciary rule. No one's going to be out there talking about retirement plans. It's like My IRA. I don't know if you're familiar with My IRA by the Obama administration. How many people here have set up a My IRA? Raise your hands.
Those bombed.
What?
Those
bombed. Okay, bombed. Because if the financial advisor isn't incentivized and doesn't get paid, this is what we try to explain to Tom Perez. They're not going to do anything and nothing will get done. Tom Perez said, so what? Because it's not my problem. And I said, well, that means all these financial advisors are going to lose their job and the employees will not have a plan. Tom Perez's answer was, oh, they can go find something else to do. Cavalier.
Yeah, they can make solar panels.
Yes. Okay. Right. They can go make solar panels. In other words, no feeling.
In Mexico.
Yeah, absolutely no feeling for this industry because, George, these people come from, and I'm just talking about this one particular party, from the land of big government and big corporations. In their brains, everybody works for a big company or they work for the government. They have no feeling for the independent contractor, the small business owner, how the financial system works. I believe Mark, whether he sells his investments or sells an annuity, gets paid the same salary, don't you, Mark, from the federal government or from the big company, right? Wrong. Okay, but see, they don't get that. Okay, and if guys like Mark, this is my theory, they don't get paid, he's got to go do something else, and that's the realities of it, and they don't get that.
Add something real quick is I do really care about what happens to your jobs, because I watched the engineering world lose our jobs when they outsourced everything to another country so that you can pay less for your computers and less for other things. So I do care, because I saw how my friends who invested in their college education, purchased big homes because they had big incomes at one time, become severely cut off from any kind of realistic income, expected to maintain a lifestyle that they can no longer even find a job for. So I do care about what happens. And I hope that we start finding a resolution for this, because we can't afford more people to become unemployed from high educated jobs. So so this is a good conversation.
Yeah, well, it's the reality, and when they're going to have hearings, I was going to go back. As much as people say, well, I don't like life insurance salespeople and annuity salespeople. Listen, they get the job done, buddy. Okay, your regular stock jock, and I've been down that road before. They ain't getting no job done anytime soon.
Nobody has sympathy for all the engineers, and I wish they did.
That is the reality of the situation, my friend. Don't rely on the stock jocks, and don't do these stupid programs like My IRA. So Mark, continue do the Lord's work and take care of these people, because we need you, buddy. Okay, don't listen to those people in Congress.
I see the light.
I see the light, baby. I mean, we need these people.
But you are the government, and we can change the laws. We don't have to let them make these laws. We can go in and change them.
And frankly, I did not. Frankly, Mark, I did not mind your annuity in 2008 because my annuity stayed on the books, allowing for me to retire. Yes, if I was in the stock market, I'd have my butt handed to me, like all those other people do. And with that, we're at the hour. I'd like to thank everybody for showing up to Tax Time. And thank you for all the conversations that we had today. And hopefully we'll be able to see you all next week around the world on Economics Monday Tax Time.